Hey guys, hope you are all having a great morning. Today we are going to continue deep diving into crypto market manipulation, picking up right from where we left off in yesterday's video. Like I said, feedback is primordial if I am to fully add wrinkles to as many people as possible, so please let me know if you like the video or any other feedback once you are done watching it. If you want to go a step further and show the channel some love and support for all it provides you, I have links below for my Patreon and one-time donations, all up to you based on how helpful this video and the channel overall is to you. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. So, we are going to be picking right where we left off, which was the part where we were discussing how cryptocurrencies experience a lot more price fluctuations and tend to face a higher amount of volatility and fluctuating liquidity as opposed to traditional fiat money systems. We also briefly talked about how cryptocurrency exchanges can be classified in two categories: either they are centralized or decentralized. Centralized ones, like Coinbase of Binance, tend to keep the assets of a user in a collective wallet. The trading here actually happens outside of the blockchain and is executed by the actual exchange. Centralized exchanges tend to experience higher amounts of fraud and theft, which show that storing cryptocurrencies directly on exchange wallets carry a significant risk of loss for the users that decide to use such services of an exchange. In direct contrast, we have decentralized exchanges, where there is a limit order book where users trade with each other by placing buy and sell orders in said order book. Users do not directly trade with each other but rather trader within a liquidity pool. The price of the cryptos is calculated using exchange-specific pricing mechanisms. On the downside, decentralized exchanges carry risk for users in the sense that there is no supervision of what is happening and users do not have to identify themselves either. We know that a great amount of the people that have started trading cryptocurrencies are uninformed or rookie investors looking for a quick ticket to the moon. Because of this, they tend to fall prey to being dominated by noise amplified by groups of people participating in pump and dump schemes. It's super easy to fall victim to a big account promoting you to buy and sell on signals that often work against everyone but the ones sending them themselves. All of this has a specific name, which is market manipulation. Let's begin with defining in specific detail what market manipulation refers to, which is a trading strategy designed to reduce the economic efficiency of the market. The most fundamental concept for market manipulation is the benefit of information derived from those involved in these schemes, which comes from reducing price efficiency and market liquidity. By reducing liquidity in markets, they undermine accuracy of price discovery by making prices less accurate as signals of efficient resource allocation, and Kyle and Viswanathan specified back in 2008. Because of the decentralized nature that cryptocurrencies offer as well as the lack of strong regulation it currently has, at least for now, crypto markets are incredibly vulnerable to different kinds of fraudulent activity, scams and different forms of market manipulation. The research into examining how cryptocurrencies is affected by scams is huge, as it seems papers seem to come out by the month from scholars and academics looking into the subject. In fact, researchers have taken themselves to task to apply data mining techniques used to develop a classifying system that aims to identify Bitcoin addresses related to Ponzi schemes. Today, we are going to examine one of these studies performed by Webster and Watson back in 2002 as well as another study performed in 2009 by von Brock. Methodology for such experiments consisted of three primary sequences, which were identification, then screening and analysis at the end. The results of this review are incredibly important to know for anyone even thinking of investing in the crypto market. The publication synthesized a variety of concept-centric searches that resulted in the identification of 7 main market manipulation methods within the crypto markets. These were pump and dumps, wash trading, order booking, stable coin manipulation by large dominating accounts, commonly referred to as whale accounts, front-running of trades, insider trading and DDoS attacks. I am going to break each of these down and each of their roles in crypto market manipulation. But before I do that, I find it super important to alert you guys that out of these 7 main manipulation tactics, 6 of them were found to have increased bot activity. That is, the main orchestrators pulling the strings for these attacks tend to like coding trading algorithms that will carry out trades based on trader psychology. This is important to know, because there are a lot of people here who think that trading in the market is an inherently easy skill to get, or that if they invest in the right online course being sold by some internet account they will somehow get a leg up on others. Maybe you will have a more advantageous fundamental knowledge of how markets work or how trading systems work with each other, but if you are to beat the game, you will need to have algorithmic bots that read all the market in a second and execute trades based on already established patterns and strategies. This is why when interviewed, most hedge fund managers that have come out say that the only way to beat Wall Street is by holding shares and not selling under any circumstance. If enough people follow this advice, then no bot will get the better of them. Now, of these 7 markets manipulating schemes that these great experiments discovered, pump and dumps received the most attention, with almost 20 full publications directly assessing them. Now, let's address each of these 7 manipulation methods and briefly summarize them. Let's begin with the most famous one first. Pump and dumps are a scheme, a strategy by which a price of an acquired asset is artificially inflated and followed by a mass sell-off to other investors. The most organic way pump and dumps happen is through the mass promotion that usually takes place in social media sites like Twitter, YouTube, Discord and Facebook. Operators behind these schemes promote certain assets, misleading their followers with wrong information so as to convince them to purchase said promoted assets and therefore boost the price, which is where the part of the pump aspect is. As other investors get in, and start promoting the asset themselves, the main operator starts to sell off inflated assets which leave investors at a loss, which is the part where the dump aspect of the name comes from. According to a Wall Street Journal publication in 2008 that investigated these trading activities for a period of 6 months, $825 million in trading volume were directly linked to cryptocurrency pump and dump schemes. We know that crypto trading and the financial part of social media has had a massive boom over the last 4 years since this investigation took place, so the number is well above the billions of dollars now. In fact, I would tally the number up in the tens of billions of dollars per month. Actors are rising, becoming influencers and leading their own followers to make investments in crypto coins, and even stocks, that have no real reason to grow. What they do is they start buying the crypto assets for months before they start pumping it. They are secretly buying without too much volume so as to maintain the crypto coins from gaining much growth or significant chatter traffic on social media. Once they invested in the asset, they start pumping it to the masses, and the crowd comes in and starts buying and telling others to buy as well. Once everyone is screaming and yelling at others to buy and hold to the moon, these actors start selling. Within a couple days, the crypto coin is typically close to being the same value as it once was. Millions of dollars are typically exchanged from unsavvy investors unaware of the dangers of falling prey to traps like fear of missing out by huge accounts with big followings, and the actors behind the pump and dump schemes get to drive Lambos to the moon. This is a pretty sad state of affairs, to be honest. Next market manipulation scheme that we are going to discuss is wash orders, or wash trading as you might more commonly known about. Wash trading is a manipulation technique where an entity creates artificial trading volume by executing trades against itself. In smoother terms, an actor comes and places a sell order while simultaneously buying the same sell order, which results in the false impression of liquidity. Wash trading typically happens within decentralized exchanges since actors need to remain anonymous while executing these trades. It would be easy for a centralized exchange like Coinbase to see the manipulation and halt the trades and possibly terminate the account and report it. You might think this is a once-in-a-blue moon kind of thing, but examination of statistical benchmarks to detect fraudulent behavior at a macroeconomic level showed that around 70% of all the volume traded in non-regulated exchanges was probably fake, showing how vast wash trading is. Further analysis by other bodies looking to see how much of all trading volume is wash trades identified that most of the manipulation is actually carried out by trading bots. Other researchers have put the number of all traded tokens subjected to wash trading activities above 30% as a minimum for decentralized exchanges. Actually, a deeper look at statistics shows that a small group of accounts were responsible for wash trading volumes worth more than $160 million. Guys, it's not some basement dwellers pulling strings here. These are manipulations carried out by big financial enterprises, which I suspect many if not all at Wall Street are involved, that love to play games like this. The third manipulation scheme is order booking. There were 2 types of manipulations found that met the criteria for order booking in cryptocurrency literature. We have order spoofing, something Wall Street is famous for doing and has been found to be a favorite weapon used by shorters to manipulate GME and AMC. The other is quote stuffing. Both of these happen a lot in traditional markets as I just conjectured, and are typically seen as illegal. Spoofing is a manipulative tactic in which a trade places a buy or sell order in the order book, but doesn't have the intention of actually executing such trade. This is done in order to drive the market in the direction that the manipulator wants. They might place a ton of buy orders on the order book in order to make it seem like there is a lot of buy pressure. Once again, research in this also suggested that bots and algorithms are the main tools used to manipulate the perception of supply and demand for certain cryptocurrencies. Again, for the case of Bitcoin particular, back in 2017 when it had a huge surge, the reason for it was the result of a large-scale spoofing of the market, all performed by one single entity. It goes to show the power that these manipulators have on the markets. It's why you see Bitcoin going from 60,000 back down in 40,000 in the blink of an eye. This which we just discussed is order spoofing. Now let's move on to the other type of order booking, which is quote stuffing. Quote stuffing is a technique in which order congestion is generated by placing a large number of orders in the book order, resulting in high frequency, which is followed by an immediate cancellation of those same orders. What quote stuffing creates is a false mid-price, or a false average price, and it creates false signals regarding rising or falling prices. As you might conclude, this will have traders buying and trading based on wrong signals which manipulators use to trap them and defeat them. We have 4 more manipulation tactics to get through, but this video is long enough and we can leave the rest for tomorrow. I hope to have opened your eyes into how large-scale these crypto market manipulations go, literally pumping coins into the thousands with hundreds of millions of dollars, if not billions, in order to trap day traders and swing traders. I hope to have served you some really insightful information. We still have a ton to cover, so be sure to keep tuning in every morning this week. Also, be sure to comment what your thoughts are down below. If you want to take it a step further and support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Hope you keep having a great day and I hope to see you later today on the recap video. Until then, keep on buying the dip into the moon.